Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. The Reserve Bank of India expects asset quality to worsen for Indian banks by September next year if there is no improvement in macroeconomic conditions. That's according to the latest financial stability report. The RBI appointed administrator of Diwan Housing Finance will chair a meeting of its creditors for the first time after the mortgage lender was admitted for insolvency proceedings. India's power distribution companies suffered losses worth 27,000 crore rupees in FY19 according to Power Minister R.K. Singh. And opposition leaders put up a show of strength as Hemant Soren is sworn in as the Chief Minister of Jharkhand for the second time. Well, let's take a look at the trade setup for the day. And the world markets had a quiet close, but, well, eked out record highs yet again for the US markets, the fifth straight week of gains for the US markets. And that tells you something about how 2019 as a year is ending. The only question that it always brings, and that every rally would bring, is whether or not a particular index or a particular stock or a particular benchmark is getting overvalued. And a lot of people would question whether the US stocks, the year-end melt up, as this chart uses the term, takes the indices into an overbought as well as overvalued territory. Well, time will tell, but for now, the bulls aren't complaining. It may be a thinly traded market, but there is certainly some uptake in the world markets as well as the resultant impact that's coming in on the Asian markets as well as the Indian markets. Now, because the Friday move was a bit tempered, you don't have some stupendous gains to the Asian screen. They are trading with with almost muted gains, if any. Nikkei is down, in fact, about 0.5%, and the SGX Nifty indicates a start, which could be flattish in the session today. So let's wait and watch if that happens or no. But you would have to admit that while there were some uncertainties in midway through last week, Friday's move paid all the hopes that bears might have had, because it was a strong move, trending move throughout the trading day and ending very close to the highs of the day, and that sets the Indian markets up for pretty strong levels going ahead as well. If technical parameters are to be followed, we are very close to or very soon we'll be at levels which would be northwards of 12,350, 12,400 as well. Mind you, all of this is happening while volatility is coming off, and for all those who haven't quite followed, India VIX is at the lowest level since May 25, 2017 on a closing basis, and that tells you something. The markets are doing well, but the volatility is completely come off, and let's wait and watch if that augurs well for trade too. We started off the new series with a bit of a bang, both on the volume front as well as on the price front. Let's see if we can take it forward in the days to come. Time will tell. For now, what we can do best is not predict the markets, but talk about stocks which might react a bit in the session today. So there are a few names that you should monitor. So Gateway District Parks, Snowman Logistics and Adani Ports. All of these would be in focus because Gateway District Parks has decided to sell the entire stake of 40.25% in Snowman Logistics to Adani Logistics, which is the arm of Adani Port. So therefore, you'd watch out for all three names. I don't know if really Snowman Logistics has any kind of gains because the price is pretty muted compared to the current market price. But Adani Port is buying a good asset at the bottom of the cycle. Gateway District Parks has already rallied quite a bit. So let's see if there's a rally there or no. But Adani Ports would be the name that I would watch out for. It's not a very large deal by the kind of size that Adani Ports has, but it's a stock that you should be monitoring in the session today. Gujarat Narmada Valley Fertilizers and Chemicals, they have advanced the plant shutdown by about 3 weeks by temporarily suspending the production of TDI. And the reason why this is important is because this is being done due to a challenging external environment and market conditions of TDI. So clearly the sales aren't the best, the market demand isn't the best, and which is why this shutdown has happened. And not the most positive of news. Let's see if there's a bit of a reaction today. Apollo Hospitals, I don't know if there will be a reaction in any fashion whatsoever, but the NHRC has issued fresh orders to cancel the registration of Apollo Hospitals in Bhubaneswar. Let's see if there's an impact here. The case is well known. I won't dwell too much on it, but this is a stock to monitor. Crude, about 12 or 13% in the last 1 month, and that's gotten the oil exploration names a bit excited. So both Ceylon and HOAC were active in Friday's session. Let's see if there is more in store in the session today. And there's an IPO listing today, Prince Pipes and Fittings. So we'll watch out for it closer to about 10 a.m. or 9:45 is when the discovered price might get known, but the base price was 178. Keep that at the back of your mind. Let's tell you what's lined up on First Word today. Darshan and Navneet first join in to take us through the BloombergQuint market poll conducted amongst 26 fund managers and chief investment officers. Advait then talks about the key takeaways from the RBI's latest financial stability report. And Sajid will tell us why Tata Sons had to change its style of borrowings. And while sales may have picked up in December, auto dealers are not willing to pop the bubbly just yet. Yash tells us why. Start off with the big one. 2020 will be the year when broader markets may make a comeback. That's what the BloombergQuint market poll is suggesting. The poll, conducted amongst 26 fund managers and chief investment officers, have responded on a whole host of other questions as well, which Darshan and Navneet will take you through. Darshan, let's start off with the benchmark indices and the upside that these participants see in 2020.
Yeah, so basically what we're seeing is that anywhere between 5 to 10% is where majority of the participants have done. We spoke to 26 individuals on as far as this poll is concerned. Let's start with the first question. And the first question was, the upside for the Nifty and the Sensex for 2020. While most of them believe that it will be anywhere between 5 to 10%, there are a whole host who do believe that 10 to 15% rally can also happen, given the fact that the benchmark indices, the large caps or the quality names are seeing significant amount of money coming to them. So that's the trend. But on an optimistic basis, anywhere between 5 to 10% is expected this time around. The next question that we asked them was that whether the mid cap and small cap end of the market will outperform this time around. So it's a convincing yes that's come in. 21 of the 26 participants have indicated yes, they will. 2019 has been a year in which it was only the quality large caps that rallied, while the Nifty and the Sensex, the Bank Nifty did manage to rally. The lower end of the market, the mid cap and small cap end of the market, did see some heavy selling that came out. So overall this time they believe the budget is also there, and ahead of the budget they do believe that a rally probably will come in which there will be traction on the mid cap and the small cap end of the market. And as I was speaking about the rally, yes, a pre-budget rally is anticipated this time around. Not a stark difference, but majority do believe that almost half do believe that a rally will come in. 4 can't say, and 9 individuals did believe that it will not come in because of the rally that's already come in. And majority of the people we spoke to did indicate that expectation of an income tax cut or a tax slab change is probably something that will aid the rally, and that will help the mid cap and the small cap end of the market. Will an income tax investments per equity investment? It's difficult because while 9 of them did indicate that it's a yes this time around, 15 did indicate that they can't say anything this time around. One of the key reasons was the corporate tax that came in. While the rally did happen on the corporate, the markets post the corporate tax cut that came in, it did manage to fizzle out in a matter of few weeks. So that's where the confusion comes in. So they can't actually say much about what will happen then. The other question was what will outperform in 2020. While banks have already outperformed in 2019, again the rally probably will continue for the banks as per the polls that we did with the guests. So they believe that will happen. PSU firms, again, the divestment, they expect decisions to come in on the budget in terms of divestment. While BPCL and Concor have already been on the block, that will come in 2020. They believe that PSUs will do it. Not too much here for FMCG and consumers. Most of them are actually trading at rich valuations. So again, a little bit of concern coming in there. And on the non-lending financial side, again, 5 of them do believe that there could be rally. You can see that companies like Bajaj Finance and HDFC have been outperformers. Their NBFCs, they believe, some of them do believe that the rally in these 2 counters will continue. The other question that we asked them was what probably will be the dark horse in 2020. Pretty much majority of them did believe autos will be there. You've seen the rally that's happened. Most of the auto stocks have rallied almost 30 to 40% from the recent lows. They believe a turnaround is probably happening in the auto sector. Real estate has been doing well for late, and that is something that they believe. Telecom has already rallied, but they believe with the changes that have come in, the ARPUs that are expected to go up, telecom will do in. Not too much for sectors like pharma and capital goods and cement, which have actually been beaten down. So auto is pretty much the sector that we need to watch out in 2020. And finally, one question we asked is what will be the joker in the pack? Trump, obviously 5 of them did respond, but majority do believe that he probably will sail through to 2020 elections. Again, the trade war in US and China has been playing out significantly, so they don't see major risks coming into FY20. Similar case was the US Fed. Domestic factors and oil, yeah, that too could be important factors that our guests have indicated could well be the joker in the pack this time around.
Well, Darshan, thanks so much for putting the first half of the poll into perspective. So keep in mind, these are 26 participants, CIOs, fund managers, and they have responded to the first half, which is the key things to watch out for, the levels that you should watch out for, and what's the kind of upside. Now, let's turn the focus to the domestic factors and try and tell you what the poll threw up when it came to some of those domestic factors, because it's very important to take into cognizance not just what the joker in the pack with regards to whether it's Trump or crude or some of the other factors, but what the domestic factors would be suggesting as well. And Navneet Johnson to take us through that. Now, Navneet, with regards to that, what does the poll throw up?
Well, Neeraj, the biggest question, I guess, on everyone's mind is when will the economy turn around? Remember, second quarter GDP numbers drew a figure of 4.5%, which was at almost 6 to 6.5 year low. So majority of the respondents said that they expect economy to turn around in the second quarter of FY21. As you can see there on your screen, almost a majority of them felt that the turnaround could come in the September quarter. But besides that, they also felt they could see some bit of improvement coming even in the first quarter of FY21. So that's how the economy poll turned around. But overall, going ahead in terms of what can be the biggest threat in terms of the domestic rally, if we get to see one even going into the next calendar year, majority of the respondents felt that this could be on account of slow credit offtake. Now remember, that's been the case, I think, throughout this financial year as well. But it was a divided house because majority of the respondents also felt that there could be a delay in the consumer demand recovery that one could see going ahead. So these two factors, I guess, will continue to play around even going into 2020. Slow credit offtake and also delay in the consumer demand recovery, which has hit, and that's what most of the managements, at least in the FMCG space, have been highlighting. Going ahead, fiscal deficit now. This has been a big surprise because all 26 respondents said that the government will not be able to meet the fiscal deficit target, which is set for FY20, and that's almost 3.3%. The recent jitters that you felt in the market last week was after some reports suggested that the government may also not be able to meet its divestment target. And if that happens, of course, that will have a weighing even on the fiscal deficit target. So I think growth will take precedence than fiscal prudence that a majority of the analysts have been talking at the start of this calendar year. In terms of rupee levels, what can one expect? Majority of the respondents felt that we are in for rupee depreciation going into the new calendar year. So 70 to 75 is the range that majority of the respondents felt, which we could see rupee to the dollar in 2020. And besides that, 65 to 70, almost 2 respondents felt this could be the range, and 75 to 83 respondents felt that we could see range above 75 as well. And Brent crude prices, upper end target that we got was $73.5 to barrel, and the lower end target was about 58.25. And lastly, gold, which has gained nearly 18% in 2019. And remember, these gains have come in after we've seen a risk on trade in global equities. There was global liquidity. And usually in a scenario like that, you don't see money moving into the gold metal. But that did not happen. 18% gains came in for gold. And if you look at the upper end target, 1690 is the range which we got from our respondents. And the lower end range was about $1386 to an ounce. And Neeraj, this is coming after, I think, gold has tipped that level of $1,500 per ounce.
Well, pretty interesting, Navneet, and thanks for that as well. Well, two things that stand out from the second half of the poll for me. One, that people are, as the last slide suggested, bullish on gold because the lower levels are about $100 per troy ounce lower than the current price, roughly. The upside is about $180 or $200 per troy ounce. So that's one. And part two, crude, which is now becoming the biggest joker in the pack. The range suggests that people do believe that there could be some upside threats to the current prices of crude as well after it having rallied about 13% in the last 1 month alone. Well, that should be something that could prove to be an apple cart, a spoiler of sorts for the Indian markets. Let's wait and watch how crude behaves in the near to the medium term. Anyways, let's move on. From this poll to stories and news, the value of bank frauds reported in the first half of the current financial year rose to a record. That's according to RBI's Financial Stability Report. The report cites delays in recognition and the main cause. Advait Rao Palepu reports.
The Reserve Bank of India in its Financial Stability Report for December 2019 has noted that the value of bank frauds has been rising. As of September 2019, the total value of frauds above rupees 1 lakh that was reported by banks has touched a historical high of rupees 1.13 lakh crore compared to 71,000 crores worth of bank frauds reported in the whole of fiscal year 2019. In fact, the value of large frauds, which is above rupees 50 crores, has reached a high of rupees 1.05 lakh crore above compared to 61,000 crores in FY19. The RBI, similar to its June 2019 report, has noted that the value of frauds has been rising mainly due to delayed recognition. In fact, over 90% of the frauds reported in the first half of fiscal year 20 were actually frauds that took place in previous years. The RBI has said that it will also bring in NBFCs and cooperative banks into the central fraud database and will also review the guidelines over its early warning signals and ensure that banks strictly comply with its directions.
Now, according to the Financial Stability Report, the RBI does not view the fall in non-bank lenders as that big a risk to the Indian banking system. Advait has more on that.
In its Financial Stability Report for December 2019, the Reserve Bank of India has made a very interesting note about the solvency risk posed by non-banking financial companies and housing finance companies to the wider financial system. Given that NBFCs and HFCs compose the two largest borrowers from the financial system, any risk of failure of an NBFC or HFC could lead to solvency issues and a failure of a bank or other financial entities. In its June 2019 report, the RBI noted that a failure of an NBFC or HFC could lead to a failure of a bank. But in the December 2019 report, the RBI has taken away this projection by saying that a failure of an NBFC or HFC today would not lead to a bank failure. In fact, as per the Financial Stability Report, the RBI has said that the failure of an NBFC in June 2019 would lead to a 2.7% erosion in the Tier 1 capital of the banking system, and a failure of a housing finance company could lead to a 5.8% erosion in the Tier 1 capital of the banking system. The RBI, 6 months later, in its December 2019 report, has revised its outlook and said that a failure of an NBFC would instead lead to an erosion of 2.5% of the bank's Tier 1 capital, whereas a failure of an HFC would lead to an erosion of 4.6% of the banking system's Tier 1 capital. Essentially, what this means is that the contagion risk that an NBFC or HFC failure could lead to a solvency risk to a bank or other financial entities has since reduced. This is mainly on account of NBFCs and HFCs over the last year and a half improving their borrowing strategy by moving towards longer term loans and longer term debt and away from short term paper. By shifting their borrowing strategy to longer term debt from shorter term debt, the risk of a failure of an NBFC or HFC is therefore reduced, and therefore a failure of an NBFC or HFC to the wider financial system has reduced according to the RBI's report.
All right, that's Advait with that report. Let's move on. Tata Sons' decision to turn into a private company has affected the lending pattern. The holding company of the $110 billion group typically invests in Tata companies, and such funding is for long periods. So what's changed and why? Sajid is here to tell us more about it. Morning, Sajid.
Good morning. Neeraj, Tata Sons, prior to converting itself to private limited company, was a public limited company, and because it was a public limited company, it has access to most of the funding sources, especially with respect to insurance companies, because they were one of the largest pool from where Tata Sons used to borrow money in forms of NCDs or preference shares. In that sense, the other thing, class of investors were mutual funds, where they were able to do a lot of investing. So they used to come into the market, but they're not heavy into it. But banks and banks, insurance and mutual funds used to take care of all their long-term funding requirement, which is more than a year kind of funding which is there. But what happened in 2018 was they converted themselves into a private limited company. This follows the spat they had with Cyrus Mistry and his group of companies, wherein they wanted to convert to private limited and get squeeze out Cyrus Mistry. As a result of which, what has happened is that this coincided with its group's strategy to pare down its exposure to telecom, reduce cross holdings and this led to a lot of fund requirement for the parent. As a result, what has happened is that in between 2018 and 2019, they started doing short-term borrowings of commercial papers, which is ranging from 54 days to 364 days. And today, of the total net debt of over 30,000 crores or 30,500 crores, nearly 24% comes from short-term borrowings in form of commercial paper. Remember, they have an approval and rating for up to 13,500 crores of commercial paper. So 7,400 crores is just half of that limit they have, and they have a cushion in case they need to go and raise short-term funds from the market. But the point is that Tata Sons normally invests for long-term periods for its group companies, whether it's buying stake or consolidating its shareholding, or for that matter investing and infusing equity into those companies, and these requires long-term funds. And this pool is now contracting for Tata Sons ever since they converted it into a private limited company. And that is one of the concerns which has been raised by two rating agencies, which is CRISIL and ICRA, in their reports as well. But they also go on to say that they have an asset base of nearly 6,50,000 crores, which is the investments they have made already in various group companies, with TCS being one of the biggest one. And they've been able to get roughly around 29,000, 30,000 crores from TCS alone in form of either dividends or in form of buybacks, which has happened. And that has also aided Tata Sons in paring down some of the debt of TTSL, because remember the telecom spectrum and other consumer business was sold off to Airtel, and Tata Sons decided to service the debt. And as for that servicing the debt, they have raised money from the market. A large chunk came from TCS and others, and the rest was in form of small stake sales that happened in TCS over the last 1 to 2 years. That has happened. So that's one big thing requirement there. The other thing which needs to be noted is that its interest coverage ratio has come down a bit. And its net debt to the investments have also gone up. Which basically means there is a pressure with respect to funding resources. Now it has been able to fund through ECBs. That's one source which it has tapped. It raised nearly $500 million through ECB in June of 2019. But ECB does not have a natural hedge for Tata Sons, because the key income for Tata Sons comes from dividends.
Sure.
And so unless you have a business which generates enough of revenue from overseas market, ECB doesn't have a natural hedge, and so they have to do extra risk management with respect to foreign currency exposure is concerned. So these are some of the things which are impacting the fundraising pool, and now even SEBI has brought in tighter guidelines for mutual funds, where they're not allowed to invest in unlisted securities. So that contracts the pool further for Tata Sons, especially if the CP program. None of the mutual funds are allowed to now invest in unlisted CPs going forward. So that would also bring in some kind of contraction for companies like Tata Sons, which are private and unlisted. So that's something which needs to be done. Tata Sons on its behalf sent across a statement. It said that they have been able to raise nearly 78,000 crores in the last 2.5 years. They have an asset base of over 6,50,000 crores, and these funds were used to take care of debt or TTSL, unwind some of the cross holdings, and they have no issues with respect to raising of funds from the market. So we are not saying that there's an issue of fundraising here. We are saying that the diversification of fund sources have come down, and dependence on short-term financing has gone up for Tata Sons.
Yeah, and that's the point. I mean, we are nowhere saying that there will be an issue. It's a marquee company, but there are issues with the model that is in right now. Sajid, thanks so much for putting that into perspective. Unlisted companies typically would have those issues. Well, the final piece on First Word today is, well, naturally, so automobile sales are coming to the end of the month, and automobile sales have seen a pickup this month. Low base and discounts have, of course, helped clear inventory before the manufacturers hike prices next year. Yash Upadhyay is standing by with that and other findings of the BloombergQuint Auto Dealer Survey. Yash, good morning.
Good morning, Neeraj. So that's absolutely what the scene has been in the month of December. December is usually the month of attractive offers. We see these year-end discounts, and this time around we've seen some of the most record discounts being offered by OEMs as well as dealers on specific models as well as specific variants, and that has aided volumes through the month of December. Now, we started off on a positive note with some follow-through of demand happening from the previous month in November, and we were just coming off from 2 back-to-back months of strong sales growth on the retail side, at least for the dealers, and we saw that pass on through into December as well. But somewhere in the middle we saw some moderation in demand, and the last few days they have seen a substantial enough pickup. In fact, even I was even speaking with one of the dealer over the weekends, and they said that there has been a sizable enough jump in terms of inquiries as well as footfalls in just the last 1 week of the month, and that is a big positive. One of the key reasons for that, apart from the huge discounting which has led to this quickness or faster decision making, is the fact that most of these OEMs, they have already announced that they would be taking price hikes of anywhere between 1.5% to 2% from next month onwards. So that is another reason why most of these buyers which had been on the sidelines for a few months or had been looking out for a new vehicle, they have been able to make that decision faster because of the deep discounting and the price hikes which come into effect from next month. But however, there have been mixed cues coming in from different regions, where in one region one dealer is doing not that well, but the other dealer is doing well. So we can't really say whether or not it has been an overall positive month. Like I also said earlier, the month started on a positive note, but since there was that moderation in demand somewhere, they might not be able to meet that expectation which was set at the start of the month. However, the regions of West as well as North, they have done slightly better than the other regions. South too is starting to look positive as well. There would be Pongal as well as Makar Sankranti, which comes in the month of January. So there is some optimism over there as well when it comes to the sales in the month of January. But overall, things look fairly positive right now, but dealers don't want to be extremely happy right now. They continue to remain cautious because a large chunk of this sales momentum, or at least the pickup in sales, is down to the fact that the dealers and the OEMs, they are offering record discounts on some of the models, and whether or not it would be sustained going forward is something that we'll have to wait and watch. But that is as far as the key factors are concerned. Let's look at how the individual companies are likely to do, and one of the biggest reasons why we are likely to see across the board a positive growth on a year-on-year basis is the fact that the low base is going to come into effect. So gone are all the confusions with respect to the high base as well as the festive sales being merged over the months of October and November. So now all of that is out of the way, and on that low base of almost around 128,000 units which Maruti did in the same month last year, we could see a sizable enough bump of anywhere between 10 to 11% on a year-on-year basis for Maruti. When it comes to M&M as well, we are likely to see that strong momentum come into the month of December as well. We will see, at least the dealers are expecting that we could see a gain of anywhere between 5 to 6% on a year-on-year basis. However, the same could not be said for Tata Motors, and that is down to the fact that they have a higher share of commercial vehicles, and that is one space which has not been doing well at all over the last several months, and because of that we are likely to see that huge drop of almost 28%. They did close to 54,500 units in the same month last year, but on that very high number, it is unlikely that they would be able to report a growth on a year-on-year basis. As far as the two-wheelers are also concerned, Hero MotoCorp, they did sales of almost about 450,000 units, which is one of their lowest in the last 12-month period. And again, on that low base, on that adjusted base at least, they are likely to do better. So somewhere around 10 to 12% growth could also be expected for Hero MotoCorp. Going forward, when it comes to TVS Motors or Bajaj Auto as well, we are likely to see a 14% growth. They have consistently done well, but we had highlighted earlier in the month that they have a high share of exports business. Almost 45% of their volumes come from exports, and they have been offsetting some of the weakness in the domestic market, and they have been consistently doing closer to around 4 lakh units and sometimes even more than that. So because of that added comfort from the exports business coming in, we could see a positive number for Bajaj Auto as well. Next in the line is TVS Motor. They have taken up price increases and have also launched their BS6 models for the top end of some of the bikes. That is another positive indication from the OEMs that they are getting prepared when it comes to the big leap going forward. But as far as the December sales are concerned, we could see a marginal 4% kind of an increase for TVS Motors, and similar would be the case when it comes to Royal Enfield as well. No large discounts that the company has ever given out, Royal Enfield, but still they managed to do well, although the numbers have come off significantly from the peaks of almost 70,000 plus sort of units that they used to do. But again, almost about a 5 to 6% growth is something that the dealers are telling me.
Okay, well, we'll get to know about these numbers in, 48 hours from now. Yash, thanks so much for putting that into perspective. That's all that we have on First Word today. But do log on to our website to read in detail about the findings of the BloombergQuint market poll. We'll also talk to Gautam Shah of Goldilocks Premium Research about market technicals and levels to watch out for in 2020, and take stock of India's infrastructure development and what the government can do to support growth with Vinayak Chatterjee of Feedback Ventures. But after this break, a full tilt towards the day's trade.
Actually